Welcome to another episode of the Federal Church Presents Better Than Bloomberg. You better start donating before your currency is worth nothing. Oh, and don't forget, it's a tax deductible contribution. So we are back to our currency collapse, sovereign debt crisis, and what else is this? Banking system collapse entertainment. So another note from Zero Hedge here. Japan to issue bonds with shorter maturities as BOJ begins tapering QE. Hmm, that must be the inflation. Maybe inflation won't be as bad in 3 months than it is in a year, than as it will be in a year. Let's get to the article. With the constant implosion in the yen, maybe not, especially with that currency collapse, threatening to spark both runaway inflation and a currency crisis in Japan, especially after the latest toothless decision by the Bank of Japan. It finally appears that the BOJ is set to either hike rates or trim its massive bond buying program, or some combination of both, either of which means higher rates. And of course, their little sovereign debt crisis there. And since the BOJ is absolutely terrified of losing control of the Japanese bond market, I think they did that a long time ago because they're now the entire Japanese bond market. They're pretty much the only bondholder of which it has been a majority holder for years. It was not surprising to learn that that Japan's Ministry of Finance is already weighing a plan to shift more of its bond issuance to shorter maturities. Major change as the central bank moves to cut purchases of government debt, one which will ensure less turmoil in the all important long end, where duration is far higher and where supply should be lower if the BOJ ends up purchasing less. Again, quite the conundrum there with massive inflation. According to Bloomberg, finance ministry officials, oh, and not to mention, just like in the European or the Eurozone, Japan likely will be printing tons of money with its involvement in the wars they're trying to stir up there too. But according to Bloomberg, finance ministry officials have prepared a draft proposal that calls for increasing the proportion of issued bonds with shorter maturities, with an expert panel expected to endorse the plan on Friday. The move comes as the Bank of Japan's decision to cut its bond purchases encourages the government to seek new sources of funding. I wonder who that's going to be. The IMF? The BOJ held about 590 trillion, $3.7 trillion in Japanese government bonds as of the end of March, representing more than half of the total outstanding. It's a complete Ponzi scheme. They're the only, they're pretty much the only bondholder, well, majority bondholder. It's necessary to reduce the amount of yield risk supplied to the market by shortening durations, according to the proposal, which also cites floating rate bonds as an option. Ooh, floating rate, meaning as rates go up, the bonds. Ah, Major buyer. BOJ holds over 50% of Japanese government bonds. Amount relative to the amount outstanding. So, yeah, it's all money printing. Similar to the so-called Yellen twist, which saw the U.S. Treasury flood the market with T-bills in mid to late 2023 to average a surge in long-dated yields at a time when the U.S. is issuing record amounts of debt. Shortening maturities on bond sales would represent a stark shift from the recent trend in which the Japanese ministry has tended to extend the maturities on bonds it sells, as the nation's policy interest rates have stayed around zero for decades by money printing. And the BOJ used its yield curve control mechanism to cap long-term yields, with basically a Ponzi scheme. The BOJ has been terrified of implementing major changes to the country's petrified bond market, which is mostly them, where the BOJ has long been the first and last buyer of any resort. Well, they're pretty much the only buyers for some maturities, aren't they? While the central bank ended yield curve control in March when it raised interest rates for the first time in 17 years, it did so in the most dovish way imaginable, effectively guiding the market to expect barely any further tightening for the foreseeable future. And the yen tumbled. Then, last Friday, the BOJ said it would release details of its plans to reduce bond buying at the July 31st conclusion of its next policy meeting. And since the market was expecting the central bank to actually do something this time instead of just more talk, the yen tumbled even more. But it now appears that some definitive move is coming, and ahead of the July disclosure, the bank is meeting with market participants to hear their views. The Finance Ministry's working draft, prepared ahead of a ministry meeting with market participants and experts on June 21st, notes that shortening maturities would increase refinancing and interest risk for the government, so it recommends expanding the pool of government bondholders as much as possible. The good question is, who's that going to be? Especially knowing they're going to print tons of money and cause inflation, tons of inflation, making those bonds worthless. The ministry sent out a questionnaire to market participants, including potential bond buyers such as insurance companies, banks, and foreign investors. So, who would want that? Especially knowing, well, rates can only go higher. Even if they don't raise rates, even if the BOJ doesn't raise rates, the market sure as hell will, especially when they're printing tons of money. So, that would seem dumber than the dipshit trade. At the last panel meeting in May, the ministry plans to release the results of that survey in addition to its proposal for future issuance on Friday, the person said. According to Bloomberg, the banking sector could become a major new customer to replace the BOJ, respondent noted in the Ministry of Finance survey. But we strongly doubt it in light of the latest news that Japan's farmer bank, the $700 billion Nikkei agricultural bank there, is getting stopped out of its foreign bond holdings, which it must sell to plug huge unrealized losses. And if Nochu has to sell foreign bonds, how can one possibly expect it to buy Japanese bonds just when yields are expected to keep rising? What we just said there. As the BOJ embarks on the first tightening campaign in decades, that's a damn good question there. The bottom line is that while the BOJ's plan suggests that the key to Japanese government bond management policy is to create an environment in which the banking sector can hold JGBs with confidence. Just how in the hell can you do that, aside from them printing more money and then creating a little vicious circle of imploding the value of those bonds and their banks while creating massive inflation too? The reality is that since in Japan monetary policy has been a total disaster for years, and the geniuses at the Fed decided to model their monetary policy after it. So, your monetary policy, in the US, the monetary policy has been a total disaster for years as well. The one guaranteed outcome is that a bond crisis is imminent. Yep, not only do you have a sovereign debt crisis, you now have a currency crisis, and it created a banking crisis, or a banking collapse, just like you saw with Norrin Shukin, who brings up an even better question. Why was it that an agricultural bank was forced to finally realize those losses, but all the other banks weren't? Likely it'll come in time. But don't forget to donate, Because that's why you're in the situation you're in. You're going to be in a currency crisis anyway, so you might as well get rid of that cash. Hallelujah.